Hi, my name is Jordan Wilson. Today we're back with another look at dollar cost averaging. And our focus will be on the ability to adequately diversify your portfolio. Now, I'm not sure all of this relates to dollar cost averaging, maybe more mutual funds or exchange traded funds. But since they're used in dollar cost averaging, it makes a nice discussion point. And it's probably in some ways much better than lump sum investing. Now, one thing with investing in funds is you get proportionate ownership. And what I mean there is you go out and you want to buy shares of Amazon or Google or Facebook or Nutrien or Cameco. You have to go out and buy those specific companies. And if you're a smaller investor, how long does it take to build up capital to even buy one share of just one of these companies? Amazon, in early April 2021, it's trading at about US dollar $3,300 a share. If you want to lump sum invest and you're squirreling away $100 or $200 a month, that can take a lot of time just to buy one single share of one company. And the reason I talk about one company is if you go back to our discussion on risk, there's non-systematic or stock-specific risk attached to each company. So you're getting no diversification by buying one share of Amazon. And you're probably not getting a ton of diversification buying one share of Amazon and one share of Google. Different companies, so yes, there will be a little diversification, but both are American, both are mega cap, both are in similar investment sectors. So not a ton of diversification. And you'll have to pay over $5,500 US just to buy one share of Amazon and one share of Google. So that's difficult for the lump sum investor. Also, you have to factor in that every time you make a trade, it's probably going to cost you $9.99. So it doesn't make sense to be buying stocks until you get that critical mass. Also, we talked about diversification and how Investopedia talked about owning a wide variety of investments. When we got into that discussion, we kind of said, okay, if you do a great job diversifying, maybe you can get by with 30 stocks. Add in some bonds, some cash, maybe 50 positions. But that's doing a very good job. You still need 30 stocks. How long is it going to take to buy one share of some of these companies right now? And that's where we move to the proportionate investing that comes with mutual funds or exchange traded funds. You buy one investment, but you own a piece of many different companies. You also use dividend reinvestment plans to help reinvest dividend income or capital gains that you are allocated. Now, I think one of the problems here is that right now we're seeing very high prices, relatively speaking, on index funds. The S&P 500, two of the larger, more popular index funds are IVV from iShares and VOO from Vanguard. Those both trade about $400 US right now. So they're not cheap either. If you're a Canadian, then a broad-based Canadian equity index, VCN, which is from Vanguard Canada, trades at about $39. Suddenly, if you have $200, $300 a month that you're investing, you can buy a little bit of the Canadian. You still need to save up for a little bit on the American S&P index funds. Now, if we look at the S&P 500, we see plus or minus 500 companies across many different sectors in the index itself. So if you buy the index, you get exposure to a variety of things for that one price. Wanted to buy Amazon but couldn't afford $3,300? Well, Amazon makes up 4% of the S&P 500. Google makes up 3%. Apple 6%. So by buying one unit of an S&P 500 index fund, probably 5% roughly of that fund will be allocated to shares in Amazon, Microsoft, Apple, Google. And that's a more cost-effective way to diversify your portfolio somewhat on a cost-effective basis. It's also simpler. I own the S&P 500. I only have to watch one investment and track its returns and track its change against my target asset allocation if I need to rebalance. I'm not trying to monitor 50 or 60 different companies and compare them as investments against other companies. So a much simpler process owning an investment. And again, the ETFs work well for the dollar cost averaging because on a relative basis, they're much less expensive to purchase a broad swath of stocks than if you try to buy them in a lump sum basis, one at a time, across that, even at 1/10 the number. Now, one question that I always get is plain vanilla equity index funds. You know, there's not much diversity, not much interest in those. What about if I like to invest by different styles, different classes? I'm missing out on that. Do I need to add specialty funds? And there's a ton of specialty funds in every style you could think of. So what about investing by style? The first thing I'll say is just to sort of take a side note, is that indices tend to be asset weighted as opposed to equal weighted. There are some that are equal weighted, but I think the vast majority will be asset weighted that you'll encounter. And what does that mean? Well, it means that the investments or the holdings or the assets under instrument skew to the large components in the index. So if I'm invested in the S&P 500 and I find an equal weighted index to invest in, I have 500 companies. So each holds 0.2% of the assets in the fund. Equal weighting. Under asset weighting, the investment reflects the market capitalization of the specific company in the benchmark index. Currently, the top 10 holdings of the S&P 500 make up 27% of the index. Now, the top 10 holdings should really make up 2%, not 27%. But that's the impact of asset weighting. So that's a problem with benchmarks and indices, is that they skew towards the larger components. But even then, if we look at the S&P 500, you want to invest by market capitalization? 80% of the S&P index is invested in large and mega cap stocks. But there's still 20% that's in the smaller, the medium to medium large, even down to small cap. So you do get some diversification by market capitalization, even in that index. If you look at the distribution of style by value stocks versus growth stocks, you see that there's probably about an equal mix of value and growth. Now, if you want to overweight, if your investment preference is value stocks, you'd want to add another investment that focuses on value to overweight that particular area. Same if you prefer growth. But just within the index, you do get a mix of value and growth stocks. There's also a great split between industries, between sectors, which also gives some diversification benefits. And if we look at some of them, right now, information technology is very heavy at about 28%. But you got healthcare, 13%. Consumer discretionary, 13%. Communication, 11%. Financials, 10%. You even have real estate in there at 2.4%. Energy at 2.27%. So again, a nice mix of sectors just in that one plain vanilla S&P 500 index fund. Okay, we're also talking about diversification and asset correlation and all that. So what about adding alternative asset classes? That often gives us good diversification benefits because they have a low to negative correlation at times to standard large cap equities. What about real estate? That's another area. Private equity. What about the trends that are out there like ESG, environment, social, governance? Is that another area where you're going to have to add specific additional investments to get that diversification? Also a question I get asked a fair bit. Now we'll move north of the border to Canadian equities. We have Vanguard's VCN. It's an ETF that holds 179 different companies across the broad Canadian market spectrum. Again, we see that it's asset weighted. Its top 10 holdings, 40% of the fund. So 179 companies, but 10 of them come pretty close to half the assets. That said, if we look at market capitalization, we still have 28% that are considered medium cap or small cap. So you get some diversification in the capitalization, even though there's a huge preponderance of allocation to the biggest companies. And like we looked at the S&P, there's also a good distribution of sectors. Financials are very heavy in Canada, 32%. Energy, 13%. Basic materials, 11.5%. Technology, 11%. Real estate, 2.3%. And the interesting thing here, just to note, is we talked about international or global diversification. So Canada and the US are quite similar. But if we compare the S&P 500 with the equivalent, let's say, in Canada, in the US, information technology is 28% of the S&P. In Canada, it's only 11%. Energy in the US is only 2.2%. In Canada, 13%. So again, just by changing countries, and geographically they're quite close, we get a much different overall allocation by market sector. So I think that's an interesting point. And as for alternatives, niche investing, sexy investment trends of the day, commodities. If I look at the Canadian Broader Index, of the top 30 holdings of those 179, I see Barrick Gold, Nutrien, Franco-Nevada Mines, Wheaton Precious Metals. If I drop a little bit farther out of the top 30, I see Teck Resources, Pan American Silver, B2 Gold, a platinum mining company. That sounds like commodities to me. It's just that they're not buying a traditional commodity only. You're buying the gold company, the platinum company, the silver company, the fertilizer company. So just by buying the index, you've got exposure to commodities. And 4 of those companies are in the top 30 holdings. So the assets under instrument are quite high. Real estate, another potentially good diversification market sector. 2.3% of the assets in the Canadian index are real estate. That's some diversification. And if we compare it with the US, with the S&P, it's about the same, 2.4%. So both of them do give you some real estate exposure. Plus in Canada, 2 companies aren't considered real estate sector. Brookfield Asset Management, which is a extremely large company. And in fact, it's ranked 6th in size on the Canadian index. So very big. And it makes up almost 3% of the entire fund holdings in itself. So it's considered an asset management company for market sector. But it's also got real estate. And I'll discuss Brookfield in a moment because it's in a couple of other areas. Canadian Pacific Railroad Company. Huge real estate holdings over the years, just by the way that they were set up way back when. They're considered railroads, transportation. They're not considered real estate company, but they have a lot of exposure to real estate. Private equity. We see Brookfield again. They focus on infrastructure, healthcare, roads, fuel distributions, and pure private equity. So they're into private equity as well. So if you're buying the fund as a whole, you get some exposure to private equity in Brookfield and other companies. Niche investing. Again, Brookfield has got their finger in every little pie. If we go back to the real estate, Brookfield is in fact, they're one of the world's largest investors in real estate. They own and operate commercial, multifamily, hospitality, housing, residential that is, They operate on 5 different continents. That's pretty good exposure to real estate and diversified globally and across different subsectors. Niche investing. Again, we see Brookfield. They are big into renewables. They own properties that generate over 19,000 megawatts of generating capacity with assets in North and South America, Europe, India, China. So that's pretty good with renewable power, again, globally distributed. Hydro One, that's water electricity. Ballard, which is also solar as an alternative fuel. So we get a lot of niche investing as well. And you also have First Service, you have Cameco, so some nuclear stuff, Northland Power, lots of niche. There's even, what's it called, Afria, a cannabis company, amongst those 179 shares. So quite a bit of diversification benefits just from companies in the general index. Maybe when you get $1 million, $2 million in assets, then you want to look at over or underweighting certain sectors, depending on your investment tactics, if you decide to go into more tactical investing. And maybe you decide, you know, the Canadian stock market as a whole, if we factor in Brookfield and Canadian Railroad, maybe that gives me 4% in real estate, and I want 10%. So I'm going to invest directly in some real estate investment trusts, REITs. Or maybe I want to invest more heavily in solar energy or cannabis or environmental companies as a whole. And there's products out there for that. But my point here is more when you're building that foundation, you don't really need to worry about alternative asset classes or niche investing because you're going to get some of that exposure within a plain vanilla broad market index. That's all I want to discuss today. Again, more about the composition of index funds than pure dollar cost averaging. But as we saw in the first slide, it's difficult to properly diversify for smaller investors given share prices these days. If you have $5,000 or $10,000 in a portfolio, you can't spread it too far if you're buying Apple, Amazon, Google. But that $10,000, even at, in my example with the S&P 500 at about $400, that can buy you a fair number of shares and give you exposure to all those companies, plus others. So again, that's a good way to invest to create that diversification. And it's probably better because a lot of the index funds are less expensive. So it's more efficient and cost effective to dollar cost average with those, even though lump sum will work. So thank you very much for your time today. We'll be back next with a look at quality in dollar cost averaging. Thank you for your time. Have a good day.